What's up, y'all? The way that this video came about was I do a ton of night reads. Night reads are what I call just really digging into the flow of a play, the chart of a play, for something I like. I let you guys know, I think last week, that I would only be doing night reads or reads in general for plays that I really liked. Those plays this week were Airbnb, which ran, MGM, which ran, AA, which ran, Tilray, which ran. And even outside of the green days. So I think that there is a method to this madness, and so many people asked about night reads. I kind of wanted to teach a comprehensive way to do them all yourself. Aside from posting those, which you're probably wondering what gives me the right to be telling you how to read this. I will say that my journey and experience is probably like most of the people watching this. I would have these really big hits, like 150%, 200%, and then I would have plays where I lost like 80%. There was no consistency, so I started really being diligent, honing down this method. My trades, good and bad, are tracked on Twitter for entries and exits, and I think you'll be able to see from the weekly stat numbers that I am gotten consistent, and that there's some merit in what I'm saying. So I'm going to use AMD as the sample for this. The reason why is because last night it looked really great for this tutorial that would be put out today, and then of course the video software was working last night. But I'm going to use AMD. This is the one that we were going to choose last night. It ran today, and I think it's a good example. So we're going to go over volume to open interest. We're going to go over digging into flow. We're going to look in its entirety at the historical flow page. We're going to create some triggers. We're going to talk about when we're going to get out of the play, and then we're going to tie it all together. So starting off, I know that you're probably wondering what you want to do first when you get to the flow screen. That's kind of the most critical place that you look. The first thing I want to talk about is premium filtering, because, for example, if I set no filter here, we're on AMD right now. If I set no premium filter, first thing I'm getting when I read this after hours is everything within a 1 minute span, because high call volume tickers, high premium tickers, high activity tickers, they tend to get more options calls in there. Whereas another ticker that's less popular, no filter, might give you the past hour or two of it. Some even have like 3 or 4 orders a day. So what we're going to do is set the filter first for the premium. Just my rule of thumb, how I like to do it is I like to see the last half hour to hour of the day when I'm going to be doing a read after hours of a stop. You'll get to know the premiums for these tickers pretty well over time. For right now, what I'm going to tell you is it normally goes in increments of 1,000, 5,000, 10,000, and like 20, 25,000 and up to give you that last half hour. For mega cap tech, it gets up to 50 to 100, like your Teslas, your Facebooks. For other ones, it stays pretty low. I'm going to cheat here and just tell you, I know from experience, AMD is about 25,000. So if we look on this first flow page, we see that we're given about a half hour. Great. So once we have that on our screen, the next thing that we want to do is see what it is we're looking at activity-wise. Now, the first thing you're going to do once you set your premium is you're always going to go to show charts. Super easy. This gives you a general sense of what's going on. This really is the one that's important over here. The overall bearish bullish volume. It gives you a snapshot of what's happening. It's not comprehensive, but it lets you know, for example, if you see that it's 75% bearish, when you're thinking about buying calls, you're going to get nowhere near that play. And then down here we have the breakdown by expiration, the breakdown by strike. Here's a heat map where you can kind of see what they're targeting on the dates by the premiums. You can see what they're targeting bullish. You can see what they're targeting bearish. That's more for people smarter than me who like that visual kind of thing. And this I like as well because it gives you a sense of what they're really targeting. So if you see a spike right here at the 121 and it's at the 130, then you know that's popular. You know it's something you want to look at and dig into. So when we see this, Our standard is on bid side and ask side, both of them. So again, looking at the show chart, we see the bid side and the ask side basically 50-50. When we turn one or the other off, either the bid or the ask, so the ask side usually skews toward calls, the bid side usually towards puts. That's because you want to think of this as an option contract order. So when something's near the bid of a spread, it's like the bid-ask spread is here. If an order comes through close to 340, here, let me highlight this. An order comes in close to 345 right here, then it's on the bid side, which means they're probably selling the put. I'm sorry, pretend this was a call, selling the call. If it comes in close to 355 on the ask, then you know that they're probably buying the call. Those are opening positions, those sells and closing positions. I used to, and I have no qualms about saying that I'm learning and growing and admitting when I'm wrong. I used to do ask side exclusively. And that honestly worked in a super bullish market where you could really just compare apples to apples and see which call of the ones that were going to get juiced were going to get juiced the most. But in this market, it skews things too much. Here's why. Let's look at the ask side only on AMD. So it gives it a little bit more bullish premium, right? So in this example, that's not too bad. But let's look at another example really quick. I pulled up MGM over here. With the bid and ask on, MGM is 63.5% bullish. Still convincingly bullish, but let's look what happens when we make that ask side only. It becomes 95% bullish. So although I like that because I think that there is a certain degree of measurement, typically if I see more than 75 to 80% on the ask side, I feel good. But you can see that in this market where things are choppy, you need to be specific. This is no longer 2020 where you could throw a dartboard and whatever's most green works. So we're going to keep our bid and our ask side on pretty much at all times until further notice. So the next thing that we're going to look for is what's going on with the actual flow itself. So here, another reason why we keep bid and ask side on is because we can get a deeper sense of what's happening. So I could see that they're selling calls here toward the end of the day. I could see that they're selling more calls toward the end of the day. I could see that they're selling calls right here, 1255. I see a bunch of puts bought. I see calls bought going into the last half hour with 15 minutes left. In the last 10 minutes, I just see so much more mix of bearish activity. But eyeballing it, I'd say this is 50-50 between sold calls, bought puts, bought calls. And our eyeball test is right because we saw that was literal 50-50. Because honestly, me eyeballing it, I'd forgotten that it was exactly that. So that's why we want to have bid ask on. That's why we want to dig into the flow that we're seeing. Show charts is great. It doesn't show you everything. Now I know that this last 10 minutes is kind of concerning me. So let's move on. The second most important thing that you have here is the quick view. The quick view is going to let you know what's happening in the moment with what people are targeting. To give you a quick tutorial for the people who don't know about volume and open interest, volume is the amount of contracts changing hands. Open interest is the amount of open positions on a contract held. Volume is dynamic. Volume changes throughout the day. Open interest is static, and it only changes once each day. So what volume represents is the amount of frenzy around a stock. The contracts changing hands. What open interest represents is the amount of people holding. So typically the rule of thumb is when you see a volume to open interest ratio of 2 or more, then that means you've got something unusual going on. Let me repeat that. When you see a volume to open interest of 2 or more, that means something unusual is going on. The higher that goes, the more unusual it is. Now, that's actually a way I snipe a lot of the plays I'm getting recently, is just by finding these unusual skews. But I want to warn you about one thing in quick view before we continue to move on. So, for example, you see that there was a whole lot of targeting of the 145, 1223 today, right? Well, today's 1223, and look, what they were targeting went in the money. So what you really want to make sure that you see when you're doing that is outside the money activity that was not near where the stock was, so you know that they're not just betting on an easy position, but that it's speculative. So again, when volume to open interest when volume is twice as much as open interest or more, and you see people betting on a strike that is outside the money, preferably near dated, that's when you know that it truly is unusual. I'm going to take a quick look at MGM here. I actually hadn't planned to, but I just want to look. So see, look, MGM here, this is a good example, and here's why. MGM is currently trading around 45. You see them targeting this 1750 call. So they're targeting 1750 call. This is 2676 compared to 7924. Pretend for a minute those two numbers were flip-flopped. That the open interest was 2676 and the volume was 7924. So that being on the 50 call, less than a month out would be a very unusual play because it'd be 2 times or more the amount, so on and so forth. So that's just a little bit about that and why we use Quick View. So when you use it, you should be looking really quickly at a checklist of 2 things. One, is the volume to open interest 200% or more? 2, are these strikes that are in the money or at the money or near the money? Or are these very interesting strikes outside the money? The other thing about volume and open interest being dynamic volume and static open interest is that you also really want to make sure that open interest stays elevated and people are holding those contracts into the next day. What you want to see is high volume, and then you want to see people holding on to new contracts. That means that it's potentially unusual position. So here, I'm really eyeing this 50 call on MGM because it's already at 1. If it has a high volume day on Monday and the open interest remains virtually the same or the volume outpaces it, then I'm feeling really confident that a move is going to happen that brings that close to 50, if that makes sense. So that's volume and open interest. That's Quick View. Remember, so we're focusing on AMD. The next thing I want to go through is the historical flow page. This one's really cool. There's a lot of uses that people don't really know about. So one of the key things I look at is this graph right here. Chart, I don't know what you call it. I'm not a mathematician. These squiggly lines right here. So in the yellow, you've got total open interest, right? Remember, we just said the amount of contracts held. The orange, you've got the price of the stock. You've got the call premium in green, obviously, and the put premium spent in red, obviously. Obviously, there's a correlation between call premium and price, open interest and price, what happens with the stock. Interestingly enough, for your contracts, don't forget these move not only with the price, but they also move with the activity around the stock. So rises in call premium, rises in open interest, all these things are predictive of rises in price, but they also just mean rises in the premium value of your stock. So what I thought I wanted to show, just to really show how real this is a few things. The first is I wanted to show you when the price really jumps is when there's some kind of divergence between the green line for the call premium spent and then the red line for the put premium spent. If they run together, the price usually stays flat, right? People are buying as many calls as puts. How you can kind of cheat and find something a little unusual is if these two start to diverge from each other. Like if one's going down while the other's going up, then that's a sign that something could be on the horizon. So like right here, for example, this basically stayed flat and went down while you saw the call premium rising up. Right there. So to show you kind of how this works as a predictive measure, I want to go to the next section, which is on put to call ratio. Put to call ratio is an important tool that a lot of people overlook. So I'm going to set this to 100 really quick, which is a lot, but I'm going to show you why. Put to call ratio typically directly coincides with sentiment around a stock. Put to call ratio is typically 0.7 is good, or 0.7 and higher is where you want to start looking out for bearish sentiment. because that's the ratio of puts to calls, right? It's getting a little higher. It's getting almost close to 1. When you go down, below 0.5 is good. 0.4 is better. 0.3s and 0.2s. I mean, you're talking about something that really has strong bullish sentiment. So you know you're going with the flow, so to speak, when you find one of those stocks. I wanted to show you the value and the correlation between price increases and put to call ratios below there so you can see just how powerful they are. So let's look really quick at one of the first bumps, June 16th, 17th. Sorry, it's hard to stay on the green here. June 16th, 17th, and 18th, right? We see this elevated level of call premium. We see an elevation in open interest. We see a slight, but not huge, rise in price. Just enough to get people interested, right? Like, I don't know, 80 to 85% is roughly 4 or 5%, so that's a good day. So let's go ahead and look at what the put to call ratios were to try to see if we can figure something out with that. So June 16th, 17th, 18th. Again, I'm just right here eyeballing this in this menu on the same page. I might need to go to page 2 here. All right, so June 16th, 17th, 18th, and 19th. What we see here leading into it is sentiment, like we said. Let's start here at the 11th, the 14th. Notice it's in the 3s that we talked about. It goes up to almost 0.5, and then look what happens in the 3s. June 17th, low 3s, mid 3s, 0.29, so 3. And then you see that look, 16th, 17th, 18th. So that rise coincided with the put to call ratio being at about 0.3 and hovering around there. Now you'll also see that it can be a little bit predictive because that put to call ratio on the 22nd, remember, was around 0.2. And then it went right there. There's examples of this. I mean, I'm not going to belabor the point, but just because I really want you to see how important put to call ratio is, I'm going to show you July 26th, 27th, 28th, and 29th. July 26th, we see it at 0.41. And then we see it at 0.38. And then we see it at 0.32. And then we see it again at 0.38. Those days coincided with a spike in premium, a spike in price, a spike in open interest. So when you see those low numbers, that's usually a very, very bullish signal. Just to really show you that it's important, we'll do one more super quick one. I'll do November 2nd, 3rd, 4th, 5th, 6th. So November 2nd, 0.32. November 3rd, 0.28. November 4th, 0.33. November 5th, 0.31. Right in that low spot we talked about in the 3s and in the 2s. What happens on November 4th? Let's see. Yep, November 3rd, 4th, 5th, 6th, 7th, 8th. You see this rise in price, rise in open interest, rise in bullish premium. So this is something that you also want to be checking every day. I look at it to make sure that I'm seeing things right. And then the next thing that I'm really looking at on here, which is my favorite part for confirmation, is on the chains. I want to make sure that I'm seeing the right thing. So unfortunately, today we're going to have to use an example with the stock that had a lot of activity on the day. So this is the 1223 144. Quick view tells us that the 150 got a lot of volume today. So I want to go look at the 1223 150. So look at that. You see on 1222 the volume. Let me actually back up a bit. This is just a measurement of this. So this 1223 150 right here we see on quick view. Looking at the historical flow is just us investigating what? We're investigating whether or not that jump was specific to that day so that we know how unusual it was. So for example, On 1220, we see it at 33.25. 1221, 10.822. 1222, 8593. And then it jumps to 30,000 a day. So I would be tempted to say, when I saw those numbers coming in today, this is unusual. This volume is higher than normal. Whereas if the volume on the day before 1223 with the 29,000 was like 30,000, then I know that nothing unusual is going on, because that's still activity based on the open interest of contracts from the next day, or that's just the kind of volume the stock typically has. So just to kind of clarify, going through the historical flow page, this shows us what's happening with the stock price, open interest, and call and put, or bearish and bullish premium. We love to see when the bearish premium is flat and the bullish premium is spiking. That's usually a good sign for the stock, because it coincides with rises in open interest and rises in price. Those rises in price, call premium, and open interest, all bullish things that we want to see, can be, again, I'm assuming bullishness is your position on this for AMD. Obviously, it works the other way if it's puts. Put call ratio, we want to see, when we're doing our nightly analysis, down below 0.45, preferably in the threes. We can live with the fours. The lower that is, the crazier it is. It's almost like the measurement of volume to open interest in that sense. Volume to open interest is the higher the ratio, the better. Put to call ratio is the lower the ratio, the better. That's a really easy way to kind of think of it. And then finally, we want to make sure that what we saw in quick view on the historical flow page also is something unique to that day. If these two volumes were the same on 1223 and 1222, then we're not that interested in it, because it doesn't represent an unusual spike in volume. We want to see frenzy. We want to see something happening that's outside of the ordinary. This whole thing, unusual whales, unusual options activity, volume, open interest, chasing weird calls, whale hunting. This is all based on things. That's why the guy's name is Unusual Whales. This is all based on unusual things happening. So you've learned how to kind of look and dig into the flow. Next, you want to figure out what to do with the chart, right? You can't just hop in blind. And that's where creating your triggers comes. So I have tutorials on this in the yeet.substack.com or the YouTube that this is on. There are 3 trigger lessons that kind of teach you how to do this. So I'm not really going to go into it here. I'm just going to let you watch that video, or assume you have watched that video. But what I'm going to say is, your trigger is the height of the price action on the way I do it. Your trigger is the height of the price action on the hourly that for the past week to 2, typically 2 weeks, has no price action above it. So, or it has a long candle above it, or it has a gap above it. So what I mean is, look at this. This is the height of the price action, right? 149.03. You see it come right up there again, right near that at 148.93. There is nothing above this level for the past 2 weeks. So if this breaks the highest point of that level, then we're going to consider that a breakout in a sense, because there's nothing above it. Again, I'm not going to go into super detail about how to do it. Just know that if you're bullish, the height of the price action, the tip of the wick in your recent price action, where for the past 2 weeks you see nothing in the way, that is where your trigger is going to be. So for example, another trigger, if this broke through, would be like right here. Why? Because of this right here. It breaks through there, it can target up to there. So really quickly going through the targets for that, your target is wherever the top of the next wick is. So in this case, it would be here. So I'd make that like a different target color. And again, this is just a super quick version of that. Super detailed tutorial on the YouTube channel below. But basically, what you need to do is set your trigger. That was kind of the point of this. So I was really just going to tell you, you're going to set your trigger to the upside and to the downside, and how its play ends up on your watch list is how close it is to the trigger. So for me, if I love this AMD read and I want AMD because of the opposite activity, but it's not close to a trigger at all, guess what? I'm not going to take it because I'm looking for unusual plays that are close to a price action trigger so that they can run on the technicals, and I know that they also have flow that says that they can make a big move. Those are where you find the powerful plays. Let me say it again. I'm looking for unusual plays on unusual whales that are also close to a trigger so that when that trigger breaks, I feel confident it can be a big play. Sometimes the whales are playing an event. Sometimes they're just playing the breakout triggers you're looking at. Sometimes they're playing other technical indicators. So the bottom line is when those things interact, that's when you have explosive plays. And going back to my own personal record for the past month or so since I've really been employing this, the proof is in the results right there. Those are the plays that you want. Those are the ones that get to home runs. So you've waited patiently. You've got a trigger nearby. You've got your flow, and you're wondering when to enter. Here's how I do it. Some people do it differently. When I'm looking for what to do after my trigger breaks, so if you just follow people's triggers online, like you don't do your own and you do it on Twitter, that's fine. So you wait for the trigger to cross on the 5 minute, and then I wait for a full retest. I always wait for a full retest. I never don't wait for a full retest. If pre-market happens, and so let's say that this is our trigger, right? So this trigger gets broken in pre-market. So now you're waking up all bleary-eyed. You've got to readjust it above, and it's a new trigger. A lot of people ask me that. Wherever the highest price is by open of the day, that's where your new trigger is. And I consider pre-market and after hours the exact same as regular hours. It's all price action, so there's no difference to me. Anyway, I'm really sorry if I got you confused on the trigger portion. For now, just know that if you're using a trigger from someone else's Twitter feed or you've drawn the trigger yourself, you need a 5 minute candle above. You need a retest of the next 5 minute candle. In other words, the next 5 minute candle has to close above that trigger line, and then you're rocking and rolling and ready to get in. And your target is the next place your price action starts or stops. So like usually a top wick. But anyway, I don't want to get too in the weeds with that. Another thing I just wanted to go through super quick. Again, this is not really a TA tutorial, but one thing that might help you is knowing your scale. So I make my triggers on the hourly. I enter my triggers on the 5 minute. And then I do my trends on the 15 minute. So what I usually do is I wait before I bail out of a play and get all nervous. First of all, you took the play for a reason, right? So you're going to give it a little time to develop. So unless it breaks back beneath the trigger with a full candle close on 15 minutes, then what I do is I wait 3 15-minute cycles and see what kind of trend I have. If it breaks a trend on the 15 minute, then you get out of the play. If it holds the trend, then you stay in the play. So for example, let's pretend, I'm doing a lot of pretending in this, that the AMD trigger was right here at 145.23, right? If it was at 145.23 and it passed the retest and it was going up there, I'm waiting, right? I'm waiting for a 15-minute cycle, another 15-minute cycle, so I could see what the price action is, and now I've got my trend. So when would I have gotten out of this play? I would have gotten out of this play, I would have gotten out of this play at about 148.46 because it closed, or about 148, because it closed outside of my trend line. Once something closes outside of your trend line for the 15 minutes, you're out of the play. I don't care what reason. I don't care what excuse. I don't care what the flow looks like. I don't care the volume. Stick to that rule and you'll be okay. Because look, You entered it to trigger at 145.23. You wrote it up. You made a nice play. You got out before things got worse, and it never got better. So to reiterate that, I make my triggers on the hourly. I do my trigger breaks and retests on the 5-minute. I follow my trends on the 15-minute. And that's how I decide to exit. The other way you can decide to exit plays, which is also good, is keep an eye on the flow. Keep this dynamic as you're going throughout the day. Maybe check this every 10, 15 minutes if you have the time, if you're day trading, to see if flow is turning against you. My general rule of thumb is once it turns 15 to 20%, I'm getting nervous. If it turns 25% the other way, I'm out the play, no matter what. The other thing you could do that's a little trick is open up your quick view every now and then here. As you refresh it, this will update. Keep this historical flow. Again, this is the historical flow page. Keep this the same so that you can see how much volume is increasing or decreasing. So if I don't refresh this page at all, this volume number stays the same on my historical page, historical flow, in another tab. But if I go here on quick view, I can refresh this all I want. So if this 55,000 goes up to 60,000, and this is at 55,000, I don't know why this is at 25,000 right now. Oh, because I'm not on the right one. So if this 1223 145. So if this 1223 145 at 55,000, all of a sudden pretend it's 60,000, and this stays at 55,000 because you haven't refreshed or uploaded it, only this tab over here, you don't refresh or upload this tab, then you'll see that it's 60,000 is higher than it's 55,000. So that's an easy way to do it so that you're not writing numbers down or trying to remember. I know it's a pain in the ass. That's a really easy way that I do it. So in summation, the way I do reads is step one, I look at the flow on the bid and the ask side. I dig into those numbers and I set a premium filter for the last half hour to hour of a day. Step two is I look at quick view to figure out where the activity is. Step three, I go to the chart to make sure that where the activity is wasn't at, near, or in the money, so I know it's unusual. Step four is I go check here on the historical flow page. I see if I like any divergence that's here, or at least if the call premium is outpacing steadily the put premium. I check the put call ratio here. So I make sure that it's on the right track. It's below 0.5, preferably in the low 4s, 3s, or 2s. And then I go down here to make sure that with historical flow, what I'm seeing is unusual. Once those things are done, I go to make my trigger. I make my trigger on the hourly based on the price action. If it breaks the trigger, I wait for a close above and a retest, a full retest on the 5-minute. And then after I've given it maybe half hour, 15 minutes to half hour to unfold, I'm creating my trend and I'm following the trend line. And that's it. That is how I do night reads. Asking questions, instructionals here on the YouTube page, the eat.substack.com. It's a short week. Next week's Christmas week, or next week's after Christmas week for New Year's. I'm excited to see the ways in which I'll create for myself to gain and lose money. It feels like it's going to be one of those weeks. All right, bye guys.